New and potentially alien regulatory regimes and themes have emerged. So what I mean by alien is that we're talking about things now that we probably couldn't have envisioned talking about many years ago. Case in point, crypto. 10 years ago, crypto was an afterthought at best. I mean, it wasn't legitimized in any way, so there was no regulatory scope for it.
Hello and welcome to Public Key. I'm Eitan Danon. In this episode, Director of Regulation and Compliance at Chainalysis Caitlin Barnett interviews Kamran Chowdhury, Technical Director for Anti-Financial Crime at BCB Group. He explains the factors impacting risk management and compliance in both traditional finance and DeFi. Have you ever wondered how tech advancements like AI and crypto are reshaping compliance in TradFi? Kamran shares the dramatic shifts in the industry over the past decade and how technology is enhancing the holistic compliance approach by BCB Group, which is a leading provider in regulated payments, wallet services, and trading services across fiat and crypto. Caitlin and Kamran discuss the current challenge of regulations such as MICA, the emerging role of stablecoins, and how regulatory evolution is influencing both established and emerging financial markets. They highlight the increased prioritization of cybersecurity in the wake of recent crypto hacks. Before we jump into the episode, did you miss out on our flagship event, Links, which took place in the heart of New York City? Don't stress. Chainalysis provides you exclusive access to the free Links virtual event. You will have access to insights from Chainalysis CEO Jonathan Levin on the crypto landscape and exclusive insights on global policy trends. You can also watch expert-led solution demos covering innovations transforming blockchain investigations, compliance, fraud prevention, and Web3 security. Head down to the show notes to register and secure your spot to our virtual event. Now, on to the episode.
Hi, I'm Caitlin Barnett, the Director of Regulation and Compliance here at Chainalysis, and I'm really excited to be joined by Kamran, who's the Technical Director at BCB Group. Kamran, thank you so much for joining us today.
Thank you very much, Caitlin. It's a pleasure.
So you have had a number of different compliance and AML roles with various organizations, from consultancy firms, large financial institutions like BNP Paribas, FX and payment companies. How did you get into compliance to begin with?
That's a great question because I never planned to get into compliance. I didn't sort of have a trajectory with compliance as an endpoint, as I'm sure many in this field feel the same.
Same.
I have always had a strong knack and a strong curiosity with regards to research and investigations. That ultimately led me to my first ever role within what was, in essence, a first line investigations role. That role opened up the floodgates with regards to my experience. As you mentioned, I've worked in consultancy, foreign exchange, payments, large FIs, and of course, the fintech space. Each role has exposed me to, I'd say, a different facet of the industry. Every role that I've had has given me a different perspective to compliance and risk management. And I think that's responsible for part of my current skill set and my mature approach to understanding controls and risk frameworks. But I would say that compliance often has the connotation about being just about rules, regulations, and ticking boxes. Actually, it's far more than that. It's about understanding patterns, behavior, and without doubt, staying ahead of the curve.
Absolutely. So, it's talking about compliance. Have you noticed any material shifts or changes over the last decade from the time you started the work you're doing today at BCB Group?
Without doubt, I would say when I first started out in my career, the average compliance officer was less data-driven than the current analog. So compliance officers now, we're more data-driven than our predecessors. When I started out, the main tools available, the main skill sets were related to spreadsheets and databases. And of course, we know that the advent of RegTech has been huge in the last few years. We're now talking about implementing or already using AI and machine learning solutions. But that alone shows you how much compliance is evolved and caught up with the technological progress. Also, new and potentially alien regulatory regimes and themes have emerged. So what I mean by alien is that we're talking about things now that we probably couldn't have envisioned talking about many years ago. Case in point, crypto. 10 years ago, crypto was an afterthought at best. I mean, it wasn't legitimized in any way, so there was no regulatory scope for it. However, right now, we could argue that it's a priority for regulators worldwide to get to grips with what a prudent framework for regulating crypto is. We've also got other initiatives which are particularly prominent in the UK and Europe, such as open banking. And once again, this type of openness in the financial infrastructure and data sharing, this was never a conversation we were having 5 or 6 years ago. So much has changed. That's great, but it also means that compliance officers nowadays, they have to navigate a patchwork of new regulation and legislation. For example, updates to the Payment Services Directive. I would just say one more thing, Caitlin, and perhaps this is the most important thing. Forgetting everything else I've said, I've noticed a big cultural shift in compliance over the last few years, which is great. It's reassuring. Compliance to me, from my experience, it's now seen as more of a strategic priority and a competitive advantage for businesses.
Yeah.
Whereas in the past, as I'm sure we all know, it was labeled as a back office function. And
And a
really, that's
cost
not true.
center.
Yeah, because proper compliance is very front office. It's very there. It's very out
Yeah.
there. I think the industry has changed materially over the last few years.
Yeah, I think you're 100% right when you're talking about going from back office cost center to more of a front office. You can't get licenses. You can't be taken seriously or be a legitimate company unless you have true compliance officers who can be front office facing, who can go talk to the regulators, explain the products, explain what you guys are trying to do. So as a former chief compliance officer, I am very happy about that material change in the cultural shift for compliance officers. So you have worked at BCB Group for over 4 years, although I'm sure many people know your company already. For those of our listeners who might not be familiar with it, can you provide just a high-level overview of the different services that BCB Group offers?
BCB Group is a leading provider of regulated payment, wallet, and trading services. So we're active across both fiat and crypto, and we primarily service the digital asset space, so crypto-related enterprises. We've got a diverse customer base within the crypto ecosystem. We have relationships with crypto exchanges, institutions, market makers, etc. We also offer more than 40 fiat and crypto pairs, so we like to say that we have deep liquidity. One of our standout points is that BCB has its own proprietary settlement system, which is called Blink, and it's available to our customers for them to transact between themselves. This is part and parcel of what we try and do at BCB. We try and make it easy for our customers to navigate this ever-changing landscape, really.
Super interesting. So you kind of touched on this just now. You have several different use cases, including on and off ramping into crypto and payments. One of the most interesting use cases is your treasury management services. As more individuals and companies play in both the DeFi and TradFi world, can you explain what makes BCB's platform so beneficial for your clients?
Absolutely. I'd say that we seek to provide a unified end-to-end solution. So we want to add value at all touch points for our customers. It's not enough for us to simply provide services. We want to be seen as a strategic partner for our customers and, once again, provide a high-touch service. I think in an era where everything is being automated, often companies who are, let's say, sometimes feeling lost in the waters, it's really beneficial for them to have that person, that industry expert to talk to. Now, of course, we're not providing guidance or advice. That's not our legal remit, but it's just good to know that you have a partner who's been there, done that in that sense. So one of the biggest things that I could say about BCB and what we offer, it's ultimately reliability. Mm-hmm. We've been a reliable partner in this market, even through the turmoil that all of us know about. We know what's gone on in the last few years. It's probably not worth a mention. Those market conditions, they've never stopped us from delivering on our core business objectives and services. And our customers know this and they associate that with us. So I would say really that's what we offer, amongst many other things.
Reputation is everything, right, when it comes to this space. So from a financial crime compliance perspective, does holding digital and traditional financial products on your platform create additional risk factors? And do you think this benefits BCB because you get a more holistic view when it comes to compliance with both the on-chain and off-chain data?
Yeah, to answer the first part of your question, Caitlin, of course, offering services across both fiat and crypto, it would increase our attack surface in the sense that offering across both assets would for sure increase our exposure to financial crime risk. Because in our payment service, whereas where we don't directly touch crypto, we offer a payment rail service. So we offer the ability for crypto exchanges to on-ramp and off-ramp. What underlies that is crypto activity. So we're exposed to hybrid financial crime risks in our payments offering. In our trading offering, where we do directly have touch points with crypto, that's where we leverage tools such as Chainalysis. So what this means for us is that this larger exposure, of course, it attracts more scrutiny, because think of it this way, we're active in two highly scrutinized spaces, payment services, but then crypto. We offer crypto payment services, so you can imagine the onus on us to get this right. And of course, we have regular touch points with our regulators and counterparties in that regard. This means that BCB Group, we really do sit at the heart of the intersection between crypto and fiat. We're also, as a direct result, able to gain and learn a lot. For example, we are up to date with hybrid financial crime typologies, allows us to strengthen our framework and innovate, and also use this to give back to our customers and realize, okay, what can we do to improve our offering and further safeguard what we're trying to do?
Yeah, going back again to that reputational perspective and being able to have those compliance officers that are front office facing that can explain all this to your regulators. So you're already an amazing guest that you have plugged Chainalysis. But since Chainalysis and BCB Group sit at different ends of the payment client lifecycle, whereas your team has insights into the off-chain data and customer activity, can you explain how you're using the Chainalysis tools and how important off-chain data combined with the accuracy of on-chain data is for your investigations as well as consumer protection?
Sure. So, of course, as you mentioned, Caitlin, BCB and Chainalysis also have their own unique perspectives on the market because we're positioned at different elements of that life cycle. I alluded to this before, but I'll break it down again. So, high level, we offer both payment and trading services. Within the payment services, we don't directly touch crypto because we're providing fiat payment rails to crypto exchanges. So, at the payment service level, we're more likely to use our on-chain skill set with regards to gap analysis. For example, we're very privileged to have access to the same tools that our customers do. So let's say we're onboarding a customer or we're doing a routine periodic check on the customer. We can use and leverage these tools to make sure that what we're seeing aligns with what our customers are seeing. And if we're not, if there's a discrepancy, we can conduct that gap analysis. We can figure out why is there a breakdown and what's going on. So whilst this isn't sort of a unique selling point of the Chainalysis product, we've learned to leverage it for gap analysis and it works very well in that regard. So we use it to cross-check results in essence. Within the trading arm where we directly touch crypto, where we have crypto touch points because we offer fiat and crypto trading pairs, KYT and Reactor form a core part of our financial crime toolkit. They're used every day. We couldn't do business without having sophisticated on-chain monitoring tools to alert us to risky clusters, indirect exposure, or otherwise patterns that require further investigation. So, as I've tried to detail, on-chain information has a very specific and useful context. And context is everything, especially in our space, because for us, on-chain data without the relevant off-chain context, it leads to very muted insights. So what use is it knowing that your customer is 4 clusters exposed to a certain source if you don't know who your customer is? You don't know what they're doing. You don't know what the benchmarks are from a behavioral perspective. At the same time, having great off-chain information, knowing who they are, knowing what they do, what their financial situation looks like is brilliant, but not being able to translate that to an on-chain environment is also going to lead you to missing the bigger picture because you may know half of what they're doing, but the full picture is not clear. So reconciling on-chain and off-chain data is something that is very close to my heart. At the same time, it can be quite hard because off-chain and on-chain data, they don't sit in the same world. They belong to different systems and they don't have a natural integration, but it's very worthwhile to bring them together to provide that holistic context when it comes to, let's say, even transaction monitoring, for instance.
Yeah, absolutely. I think you brought up a really good point that people who aren't familiar with blockchain analytics might not understand, where you can use blockchain analytics to essentially get a snapshot into your potential customer's bank account, right? So if they give you documentary evidence that they don't allow interaction with sanctions, you can very clearly go and check using Chainalysis products to see whether or not that's true. And I think coming from a TradFi perspective, that's just foreign, right? Because you don't have that exposure. So that was like my big selling point, my aha moment when I saw blockchain analytics. So it sounds like it was very similar to how you approach it as well, which is cool.
Absolutely, Caitlin. Yeah, we leverage it from a KYB perspective. As you mentioned, it's so useful because an on-chain trail is immutable. You can see the trail of events that have led to a certain attribution. So if we see exposure to gambling, for example, of course, gambling is also legal. I'm not saying by any means it's not, but it could sit at odds with our risk appetite. So it's very important to understand where the provenance of that gambling exposure is and what we can then do. So Chainalysis really helps us in that regard.
Yeah, it's so great to hear. So you have several crypto customers. One of the biggest risks to crypto companies has always been maintaining banking relationships. With the early days, many being de-risked by banks or being charged exorbitant premiums to keep an account. Have you seen a shift by banks now that they are venturing more into digital assets themselves, or do you think this is still a contentious issue within the industry?
It's a bit of both. I am seeing a good shift. So even large TradFi players right now, they are entering the crypto space, for example, to offer crypto custody services. Actually, I read only a few days ago that one of Spain's largest banks, BBVA, they're now offering ETH and Bitcoin trading and custody services. So that shows that a huge player is able to reconcile crypto with their legacy risk appetite. Yeah. So this evidences that clearer regulation, which is coming into Europe, clearer regulation and standards is allowing banks to revise legacy and potentially outdated risk frameworks. Banks are then going to be more willing to engage with crypto companies who have prudent and robust control frameworks. However, Having said that, the caveat, regulatory clarity is still evolving and smaller companies, truthfully, are still struggling. It's the bigger players who are benefiting. These smaller, more agile shops, they are struggling. And for these companies, maintaining banking relationships is still a key strategic priority, and it's very resource intensive. In the TradFi space, we almost take it for granted. So I can speak to the UK because it's a market that I'm very familiar with. Payment services companies in the UK will get banked by a tier one bank with relative ease. They'll go through a straightforward DD process and they'll have their accounts. However, a crypto company will really struggle to do the same simply because that crypto label almost always triggers the de-risking alarm bell over at the bank. So crypto firms, it's almost like their banking relationships live in their heads rent free. They're always worried about their banking relationships. And that's part and parcel of why BCB exists. We're here to try and solve that pain point and really help our customers sleep easy at night.
Definitely is a huge concern for compliance officers.
Yeah.
As someone who has an intimate view of the financial crime space, working with both large companies in crypto and payments, what do you think is the most existential risk to both the DeFi and the TradFi space?
This isn't a fair question. I can answer in 100 different ways. Thematically, I would say that the biggest risk to both is that the complexity of both systems, of both TradFi and DeFi, or of crypto and TradFi, could grow to a pace where it outpaces the risk management capabilities. And by that, I mean, for example, if crypto grows too much too quick and TradFi grows too quick, we may not have the proper tools and frameworks in place to allow it to grow safely. And that almost always leads to an explosion at some point, as history shows.
Yep.
So as an example, in DeFi, a major Oracle collapse could trigger a contagion event across DeFi.
Yeah.
In TradFi, perhaps a breach of settlement rails, it could freeze liquidity globally. And one thing we're noticing as more and more TradFi incumbents enter crypto, these two worlds that used to be seen as so far apart, they are converging and they're becoming more interconnected.
Yep.
Interconnection and globalization is great, but it also means that issues in either could have a widespread implication for the other. And that's why I'm going to go back on what I said about risk management. Now, more than ever, risk management must evolve to match this increasing complexity. So I'd say that's the largest outstanding risk from my view.
Yeah, I think that makes a ton of sense. So are there any illicit typologies that you've seen emerging in the last couple of years that you haven't seen in the past that more compliance professionals should take note of? Probably also an unfair question because there are millions you could choose from, but we'll take your top one.
You beat me to it. There are a lot of new typologies. There are also new iterations of existing typologies. So it's not always the case that criminals have to reinvent the wheel. They can also just use an existing typology in a more smart way. Yeah. Having said that, I'd say one of the most prominent new typologies that wasn't around a few years ago is the increase in cyber-enabled crime via generative AI. So we're talking about synthetic ID documents, which are able to bypass standard KYC and IDV checks. It's interesting because AI on one hand is allowing for criminals to proliferate in their criminal activities, but at the same time, the very solution to these issues could also be AI and machine learning driven. For example, a solution to synthetic ID fraud could be behavioral biometrics, and that would be more of an algorithmic machine learning based system. So it's that double-edged sword of AI. It gives and it takes, that balance we have to find. A few other things that I personally have found very interesting and I've done a lot of deep research regarding are the increasing complexity of cross-chain laundering. We've known for a long time now that, of course, Bitcoin is not the only space for laundering, and year-on-year publications by yourselves at Chainalysis show that liquidity is now much larger in other chains, and where there's liquidity, you can hide stuff. Things are no longer a drop in a bucket, they're a drop in the ocean. But also the methods used to cross-chain launder are becoming more and more complex. So there's more and more sophisticated uses of bridging of DEXs and swaps. I'm sure we'll probably get onto this later, but the Lazarus Group, interestingly, they're even using meme coin swaps to launder money, which is actually crazy if you think of it. So that's just showing how cross-chain laundering is just increasing at a scale where it's becoming hard to catch up with it. Lastly, I would say stablecoin-based trade-based money laundering. So certain stablecoins are now a home for a lot of sanctions evasion by certain regimes and actors. And that's, once again, intel that more and more analytics companies are posting about, for example, Chainalysis. Those are the three themes that I personally focus on, because I think from those three themes, you can unpack a lot of other typologies.
For sure. Yeah. And anytime you're dealing with criminal enterprises, it's almost like whack-a-mole, right? Like the minute you figure out whatever typology they come up with, you put controls in place and then they get smart. Criminals are smart. You can't say that they're not at this point, that's for sure. So one of the few elements that crypto and traditional companies are well aware of is transaction monitoring. How are these industries different, and what processes are more similar than people think?
I think I'll break this down into two questions. They are similar and different at the same time. So when it comes to, let's say, transaction monitoring across both crypto and TradFi, with crypto, there's a stronger focus on real-time on-chain monitoring utilizing advanced methods such as clustering and pathfinding, which are all things that Chainalysis offers. This allows you to understand the provenance and destination of the assets, but without further information, you don't necessarily know who the underlying actor is, right? You can see a cluster, you can see how it behaves in response to other addresses, but you don't know actually, without further attribution or evidence, who's behind that. Now, TradFi, on the other hand, has a stronger focus on framework. So you know who you're dealing with, but you don't always have that end-to-end transparency over what they're doing without further information. So we may paint a picture that they're both different. They're also similar in the sense that actually, whether it's TradFi or crypto, if you're talking about a mature company in either space, they will be leveraging both. They'll be leveraging strong insights, strong reg tech, but they'll also be basing that on a strong fundamental framework, because you have to make sure your house is built upon strong foundations before you add to it. So I'd say whilst I started off talking about differences, actually they're probably more similar than people think. And on that note, in terms of what processes are more similar, it's sort of what I said already. If you're looking at strong players, established firms in the crypto and TradFi space, all of them they'll appreciate what it means to have an end-to-end controls framework. So they know how their transaction monitoring feeds into their ongoing monitoring, and they know what that ongoing loop is to make sure that they're protected firm-wide. So I'd say, there's a lot to say that is similar across both.
Yeah, and I think there's probably a bit of a misconception that, crypto transaction monitoring is so different from traditional fiat transaction monitoring, and that it's way more technical and way more burdensome, where, again, my own personal bias, I think it's easier at times because you're not Googling Caitlin Barnett LLC. You're quickly seeing that it's coming from a darknet market, or it's coming from a legitimate exchange that you have no concerns about. So I think, education in this space continues to be super important, just to highlight that there really aren't these grave differences.
Absolutely, yeah. And I think at the operational level, whilst there are a few differences, that's more so just getting to grips with a new learning curve. Once you start doing it, seeing how our teams actually work and disposition alerts, it's very similar to what you do in TradFi and across Web 2, so to speak.
Yeah, absolutely. So you kind of already touched on Lazarus Group. So I think everyone listening to this episode is well versed to know that we've seen a bunch of hacks, and DPRK continues to be one of the biggest threats to this community. So what can you say high level about hacks and your thoughts on how the community in general reacts to these DPRK attacks?
High level, using the recent example, I would say one of the clear findings is that the speed at which the analytics space attributed these events to Lazarus. So straight away, on-chain investigators were able to find previous test addresses utilized by Lazarus and link them to the cluster that's involved in the recent event. So that's showing that the analytics space is getting smarter. In the past, this would have taken several days, and I think it took about 24 hours this time. So you can see the pace is evolving. At the same time, Lazarus is evolving in response to that pace. So we can see this time, I've been trying to carefully follow the millions of webs of transactions that just on my screen when I'm trying to look at what's going on. But Lazarus seemed to be laundering in a much more fragmented way than usual, which probably reflects a sentiment that they know that everyone's onto them. They know they can't act with the same level of impunity that they used to, because they will get frozen if they touch a centralized touch point. So they're using different methods or slower methods. I think even they're utilizing old mixers, for example. So I would say that the recent events show that a strong coordinated approach is very, very much necessary, because this has an industry-wide impact when a crypto exchange gets hacked. Also, recent stats show that around 20% of the funds have gone dark, which means that they could never be recovered. And of course, we know that North Korea is not exactly an open regime. So if 20% of funds have gone dark, it's unlikely that recovery attempts will be successful. So this once again highlights the impact of these events and the need to act quick and in a coordinated fashion. I would say one other finding from the recent events are questions surrounding information sharing, both positive and negative. Of course, I guess we can unpack that separately, but there's a lot one can say about that.
I think we could probably do a whole episode on just that topic alone.
Time for it.
Do you believe that this is just the start of a new attack vector that hasn't been opened by the most infamous hackers in crypto and in traditional settings? And what can other crypto companies do better to protect themselves?
That's a really good question, Caitlin. I think, of course, with the caveat that I'm not a cybersec expert, but the underlying tactics involved in the recent events were, in essence, the same as always. There were potential social engineering, phishing, device compromising, and spoofing. None of these are going to alarm anyone in the cybersecurity community. Everyone knows what these are. So these underlying tactics are not new. I'd say what was new and what was surprising was the scale and the level of sophistication at which Lazarus was able to use these techniques, because they were able to do it in a way that simultaneously targeted both technical and human vulnerabilities. And I guess this reiterates the very well-known saying that your security is only as strong as your weakest link, whatever that weakest link is, whether it's human or it's technical. And that's a stark reminder for crypto companies. Going forwards, what companies can do to safeguard themselves, I guess it would be things like further securing your developer environments, enforcing stricter transaction controls, definitely doing further vetting of your third-party integrations, overall training. I know this talks about, for example, introducing zero trust structures too, but that's a very cryptographically intense procedure and it's probably not something available to every firm out there who's worried. So I'd say what every firm can probably learn from this is make sure you're doing the small things properly, because actually what these events show is that it was the small things that ultimately allowed Lazarus to enter the system of the entity they hacked.
And I think wild to see that like all of these little small things can add up to such like a grave situation.
Yes.
So switching gears a little bit, as you know, 2025 has been the year to discuss regulation with MICA coming into effect and regulations in the UAE, Hong Kong, Singapore, and obviously a lot of momentum in the US with the new administration. Where do you position the UK when it comes to crypto asset regulation? And can you explain some of the many licenses that you have to operate in the EU region?
Absolutely. So let's start by talking about the UK, because I think there's a lot of strong opinions on this topic. So to say it bluntly, the UK is taking a methodical yet slower approach because the overarching aim for the UK is to balance innovation with consumer protection. So broadly, they're trying to develop a framework that is comparable to the EU's MICA regulations. Now, this measured approach by the UK is measured because they want to be able to tailor the framework to the risks of the home market, right? However, this also raises a very legitimate question, which is, does all this mean that the UK is just too late to the market? Have they stifled innovation? Have they taken too long to come up with this? And are firms now moving elsewhere where the regulatory clarity is stronger? I'm not looking for an answer there, by the way. There's yes and no answers to that question, but it does raise a very interesting question about potentially overreaching and the scope of regulation stifling innovation. To now speak more directly about BCB and what we hold from a license point of view, in the UK, BCB is authorized by the FCA as a payments institution. In France, we hold two licenses. So via the ACPR, we are an e-money institution. Via the AMF, we are a DASP. A DASP is a digital asset service provider. Also in Switzerland, via the VQF, we are a FINMA recognized. We're part of the FINMA recognized self-regulatory authority. So in essence, BCB Group holds all the requisite licenses to do business safely and sustainably across the UK and Europe. And we've not been afraid to chase the tier one licenses. Getting a license in France is not an easy task by any means, but we've done it. And we did this for two reasons, because we want to be part of a strict regime that knows what it's doing. But secondly, we also want to give our customers and counterparties comfort, because just by seeing that we have a tier one license, they know that we sort of know what we're doing. And that's that reputational impact. I think reputation is always a theme, and it's that reputational impact that it has for us.
And I think you bring up an interesting point, on the regulator specific to the UK and not giving an answer one way or the other. But I do think one thing that a lot of people who live and breathe crypto daily kind of forget, the regulators don't. It's a very, very small fraction of their overall regulatory portfolio. And so in some sense, when we see some of the regulators moving at a slower pace to balance that innovation, it does make sense, right? Because if you were to come out very quickly with regulation, we see how quickly the crypto ecosystem moves. So they're going to come up with something new tomorrow that is going to make the regulation outdated within 2 weeks. So it's a really hard act to balance. So I do show a lot of empathy for the regulators. And I do think oftentimes they are given a bad rap, but they're not living and breathing it like the rest of us.
You're so right. I do echo your sentiment. And to add to what you said, Caitlin, regulation doesn't exist in a vacuum. It's iterative and it changes. And I think the FCA in the UK has done a very good job, because quite often they release consultation papers where they actually reach out to industry saying, okay, what do you think about these themes? What can we do? And they consolidate those responses to inform their next steps. So yeah, I think we do need to cut regulators some slack too. They've not got a very easy task whatsoever.
Yeah, and now give BCB some brownie points for giving that slack as well, right?
Exactly.
So as MICA and the TFR continue to roll out, and there seems to be a lot of confusion when it comes to reading these regulations in unison with guidelines from the EBA, et cetera. What are your overarching thoughts about MICA, which also could probably be an entire episode? So feel free to just go as high level as you'd like.
Yeah, my first question is about to be, how long do you have?
Yeah.
High level, MICA and related regulations, such as the transfer regulations, they mark the largest step towards harmonizing EU crypto regulation, which is brilliant, because this is what we've been screaming about for years. We want harmonious, consistent regulation across markets, right? However, the success is a different story. So the success of these regulations and guidelines, that would hinge on a consistent implementation. And that would require clear guidance to avoid fragmentation, because on paper, it's a unified regulation, right? But what if different countries have a different interpretation of the guidance? They apply it differently, and that leads to fragmented understandings, which are not transportable across jurisdictions. This is why the regulators are being highly cautious, and they're making sure to provide clear guidance that is equivalent across jurisdictions to counter the highest risk of fragmentation, really.
So do you think having such a comprehensive regulation is beneficial for the EU adopting and innovating in digital assets, or do you believe the cost to get a license and follow the compliance requirements will potentially price out many of the players in the region?
As with most things in this industry, Caitlin, it's a balancing act. So there are good and bad if we put it on a scale. The good or the great is that the industry for a long time, as I mentioned, has demanded a consistent regulatory framework. Markets hate uncertainty. So with this certainty coming in, that's going to allow crypto to be more comparable to TradFi. This certainty will attract more players to the market. At the same time, it will probably drown smaller players who don't have the resources or time to come to terms with these onerous requirements and regulatory burdens. So whilst these comprehensive regs that allow companies to position themselves at the forefront of, I would say, what is an increasingly legit industry, it's probably going to be very concentrated in the sense that those who will benefit the most will be the bigger players who have resources to do so. Smaller agile shops that are otherwise great may unfortunately get priced out. It's up to them to decide what their direction is.
Compliance does have a cost, unfortunately. So similarly, does the new implementation of the travel rule help compliance programs to reduce fraud and scams due to the amount of beneficiary information that will be needed, or does it just add to the burdensome reporting requirements for most crypto companies?
It does help because conceptually the travel rule is trying to create a system similar to Swift messaging, which will not allow for anonymous transactions. It's much harder to operate anonymously in this new world. So this enriched information will of course assist financial crime departments because it leads to more transparency. Compliance loves many things and compliance loves transparency the most, probably. So without doubt, it will be beneficial. However, you already mentioned, Caitlin, that there will be cumbersome reporting requirements, particularly at the start. So these will naturally lead to operational challenges. So the main challenge for firms is going to be how to find balance between compliance and innovation, how they can grow without compromising their regulatory requirements that are ever increasing and probably are going to change time and time again.
Yeah, I would expect that. I think that's a good bet. So what have been the biggest advantages and challenges for your clients that are also operating in these regions?
The biggest advantage, I would say, is something I already mentioned. It's that the knowledge of regulations coming has allowed for certainty and consistency. And for firms, part of the battle is actually just knowing what's expected. It's very hard sometimes. You're sometimes playing a guessing game of trying to figure out what your counterparties and regulators want of you. But now having hard caps and knowing what's required is great. And as I mentioned before, markets hate uncertainty, but they love certainty. So that's brilliant for everyone. Most obvious disadvantage that I could spell out is that it will lead to more complexity and it will lead to a higher cost of navigating new requirements. So this certainty comes at a cost, and the cost is operational and financial.
So stablecoins are increasingly becoming the killer app in crypto accounting for almost 2/3 of every crypto transaction. We have seen a lot of regulatory scrutiny that seems to be dulling the teeth of this innovative technology to provide inexpensive cross-border payment options. What are your thoughts about stablecoins and the regulations in the EU and elsewhere that may impact their usage? Man, every question I'm asking you could be an episode in and of itself. So again, feel free to answer however you see fit.
You prepared well today. Stablecoins for sure have attracted significant reg attention in not just mainly, but if you look at the news, it's the US, UK, and EU that's sort of leading the charge against stablecoins, or the charge to support them. This is not my area of expertise, but from what I understand, the US proposes to extend banking-related acts to stablecoin issuers. So stablecoin issuers would fall as part of the banking system proper. The UK is a bit different. The UK is proposing to treat stablecoins under their electronic money frameworks. But I think the overarching theme is similar, that they see stablecoins as a form of money, and that form of money needs to be prudentially regulated and supervised. So in the EU, MICA itself, it imposes strict requirements for certain stablecoins, such as they must be one-to-one backed with low-risk assets. And that does mean that certain stablecoins will not have a home in Europe anymore once the legislation is fully passed and the grandfathering period is over. So certain stablecoins that don't meet those hard caps, those requirements, will have to go elsewhere. So it will fragment the market, and it will probably create some type of arbitrage where a certain stablecoin will be more prominent in developing markets, and a certain stablecoin will be the proxy for the developed markets. So in addition to that, the biggest challenge I would say lies in preserving the transformative potential of stablecoins whilst all these regulatory changes are taking place. Because I think MICA and their equivalent frameworks are great for reasons that I mentioned, but they come at a risk, and the risk is stifling the underlying utility of stablecoins. That marriage needs to be very carefully evaluated.
Absolutely. So, taking the industry as a whole, is there any technology or initiative that you see emerging in the industry that you're excited about? Whether it's real world asset tokenization, various new ETFs, what excites you the most?
What excites me a lot is something that was quite prominent many years back, when the metaverse and Web3 narratives were super hot, and then it sort of just died and all the vaporware left. There's been one concept that is still around because it has a legitimate value proposition, and it's called a decentralized ID, or a DID. It's a unique identifier that's linked to a user's public-private key pair. So in essence, their ID is cryptographically verified when they share it.
Yep.
And this eliminates the need for a centralized intermediary. In essence, you are in charge of sharing your ID details. And having said all of that, I think the biggest benefit of this is because a DID is going to enhance information sharing and privacy, because it allows you to share only what's required.
Yep.
That avoids data misuse. As a more practical example, let's say that someone is asked to prove that they were born in 1990. They might present their driver's license to prove that. But in showing that, you've shown your age, your address, your jurisdiction, what vehicles you're authorized to drive, and any other metadata associated with the driving license. So for one piece of information, you've given away potentially 5 unnecessary points of information.
Yeah.
DIDs do away with this data misuse and this data oversharing. And that also then eliminates single points of failure, because only one piece is being shared through a more sort of zero trust or zero knowledge mechanism. And I would say DIDs, they're going to be a huge part of the building of a user-centric digital ecosystem. So that's why I'm so keen to understand more and more about DIDs.
I'm so glad you said something like that instead of some of the things that I mentioned, because I find that to be a super interesting use case. Okay, so can you share where or what is next on your roadmap, and what announcements or partnerships that you're excited about as we continue on into 2025?
Absolutely. For myself, and primarily for BCB, the focus for 2025 is to scale our core offerings for scalability and sustainability. So a large part of what we want to do is improve upon what we already have, and just offer a stronger, sleeker, and more streamlined service to our customers. Having said that, we're also launching new products, and one of our latest launches is Flex Collect. Now, Flex Collect, it enables the collection payout processes across currencies. So imagine you're a customer with both a fiat and a crypto treasury requirement, or a treasury in fiat and crypto, and you may be a payment service agent, or you may be a merchant acquirer or something, where you have both collection and payout needs. Flex Collect is going to allow you to do that all in a unified platform. So it really simplifies complexity, and it unifies it in a single consolidated platform for your access.
That sounds super
I'll tell
exciting.
everyone to stay tuned and look out for that.
Yeah, for sure. So what is the best method for our listeners to see what you're working on and to connect with you on social media?
LinkedIn, without doubt. Just search my name up and you'll find me. But I'm trying to get more and more active on LinkedIn, and if I'm not posting, I'm probably liking something that someone else has posted. So just reach out, and I'm sure if there's a conversation to be had, we can have it on LinkedIn.
Kamran, it was such an absolute pleasure having you today. Sorry so many of my questions were heavy hitters that could have kept us here for hours, but I'm so glad we got to chat, and really appreciate you taking the time.
It was a pleasure, likewise, and thank you very much, Caitlin.
Kamran did an amazing job covering some of the key technological factors impacting risk management and compliance in both crypto and DeFi in particular. This is a great time to mention that recently, our very own head of cyber threat intel, Jackie Burns-Coven, delivered testimony before the House Financial Services Committee about the tools and techniques required to combat fraud. In Jackie's testimony, she shared recommendations around modernizing and streamlining scam reporting and responses between public and private sectors, enacting legislation that ensures a unified regulatory framework for crypto businesses, and closing AML-CFT gaps for FATF members, among others. Head down to the show notes and click the link to watch the full hearing, which is called Following the Money: Tools and Techniques to Combat Fraud. Before you go, remember, if you learned something new from this podcast, we encourage you to share with a colleague or friend. You subscribing and sharing the podcast allows us to bring on some of the biggest guests in the crypto and blockchain industry, and to share their knowledge with you, the audience.